Welcome to the fourth episode of Dividend Discussion here on Dividend Obsession. With this new series, one of my goals is to share my passion for passive income through dividends with others. During these interviews, we're going to hear the story of someone else that's doing dividends their own way. Hopefully, you, the viewer, can take something out of each and every one of these interviews to make yourself a better dividend investor. For my fourth guest, please join me in welcoming Justin. He's another one of my friends from the Dividend Growth Investing Facebook group and has been investing for over 2 decades and has amassed over a 7-figure portfolio. In this episode, we discussed how keeping things simple works, lessons learned during his time of investing, why he doesn't believe in yield on cost, and much more. But without further delay, please enjoy the show. Welcome to another dividend discussion with my friend Justin. So Justin, if you want to go ahead and give yourself a brief introduction, we'll get this thing going.
Hey, I'm Justin. Happy to be here. Thanks for having me. I'm down in College Station, Texas, retired Air Force pilot, current corporate pilot, and been investing for about 27 years now. So,
very cool, very cool. So, what are you allowed to say? What airline you're a commercial pilot for?
It's for a private company,
Oh, that's cool.
And it's a company that nobody's really heard of. Yeah, if I told you the name, you wouldn't know. It's a local bank.
Is there a big difference between the two pilots?
Yes. Depending on who you ask, I'm a huge fan of corporate. I like quality of life in there. I don't like flying a lot. Airline pilots are on the road a lot. They're staying in hotels and riding in airport shuttles and yeah, I don't really like that. We go to nice places. We fly some interesting people. We do some charter on the side too. So I've met some interesting people, folks I see on CNBC, which is pretty cool. Jonathan Gray from Blackstone Group. I just met him about 2 weeks ago. I said, "Hey man, I see you on CNBC all the time." It was super cool. There's a computer guy over there in Austin, Texas. It's got a pretty big operation. I've met him a few times. So yeah, it's interesting. Let's see. The ex-Google CEO. I did most of his flight training a few years back. I had a very embarrassing recommendation to use Gmail from him because I gave him my Hotmail account for him to email me something. And he's like, Gmail's better, right? And I said, really? And the guy sitting next to him is just laughing. And it dawns on me, the Google CEO just told you that Gmail's better.
That's funny.
So now I have a bunch of Gmail accounts, and I love Gmail.
Hey, we're on Google Meets, so there you go, full circle.
Yeah,
there you go.
But yeah, so it's different.
So have you met, and this is not related to the interview at all, but have you met any people that you were hoping would be nicer that weren't? You don't have to call out their name. Like, we don't have to call them out. But
let's see. I don't want to name a bunch of folks on there. I've met at least one infamous person from the hedge fund community, and they were a lot quieter and more reserved than I thought.
Yeah.
Huh. So I will say, obviously, if you're chartering airplanes and especially big airplanes, you've got money, right? Everybody in that community is somebody.
Yeah.
The ones you remember are the ones that are incredibly nice, right?
Yeah.
Or personable or easy to talk to, right? There's folks out there that, and Mr. Gray from Blackstone, he was that example. We're two very different people and sat down and had a great conversation and super interesting. And I cherish the time that I got to spend with him there a little bit. Those are the ones you remember. Yeah. So both, I also flew distinguished visitor, senior leader airlift in the military. So I got to meet senior leaders there too, both military and civilian. And it was kind of the same things. The ones that are awesome at their job, but can, see a book sitting there and go, oh, hey, somebody just gave me that, and have a totally normal conversation with you, and then immediately swap to give you a synopsis of what's going on in world events.
Yeah.
Right. Those are the folks that, to me, are super, super impressive.
Yeah, that's always cool. Like that's one of the things that's always scary is they say like you never want to meet your idol for that reason. Like you end up meeting them and you're like, oh, you're not anything like I thought you were.
So obviously I work for a very successful guy, self-made guy. Um, and it's been absolutely wonderful getting to know him and chat with him. I've flown with some other folks that I did kind of regularly, and so I met him, trained with him, and he was super nice. And I had asked ahead of time because he was kind of the first big name guy that I had trained, and so I asked around about him, and they were like, "Oh yeah, he's super nice." Well, then I started flying with him and got to know him more, and he got to know me more and got a little more comfortable around me. And yes, he's super nice. He's also a super driven guy.
Mm-hmm.
And so, sometimes the public persona is a little bit different. Still, have tons of respect for the guy or whatever. But yeah, the behind the scenes, kind of persona is a little bit different too. But you're a super successful guy, right?
Yeah.
Or girl, doesn't
Yeah.
matter which. But
Yeah, that's always cool. Like my biggest, like I'm a really big Thunder fan. I'm in Oklahoma City. We actually moved here for that reason. And then like
cool.
I'm a really big Cowboys fan too, Dallas Cowboys, and Dak Prescott is
Jerry Jones, huh?
yeah, no, not Jerry. I'm not a fan of Jerry Jones. Like that guy just gets in his own way. But he, yeah, Dak Prescott he's my favorite. Like seems like a great dude. Even we just named our 5-month-old son after Dak Prescott. So his name's Dakota.
I flew Tony Romo, and yeah, don't put this on. But him and somebody else, and I introduced myself to him. I picked him up after a game, I think in Jacksonville, and the guy he was with introduced himself, and when I met him, he didn't say his name, and I was like, "You should probably introduce." I didn't say that to him.
Yeah, who are you?
Probably say your name, bro. Not everybody knows who you are.
Yeah, yeah.
But anyways, he was super nice.
That's always So I'm like, I want to meet Dak Prescott because I like him a lot. Like he seems like a really personable dude. Like I like his story and how he's brought up and all kinds of stuff. But then if I did meet him, and even if it was a bad day and it just rubbed me the wrong way or whatever, I'm like, man, that would ruin a lot of things. So that's up in the air. We'll see. But anyway, okay. So my first question is going to be for you: is what got you into dividend investing, and when did you get started?
So what kind of got me? I'm going to go with what got me into investing. It was a core management class. I went to school at the Air Force Academy, and let's see, sophomore year, they had a whole section in our core management class about investing. Time, basic stuff, time value of money, dividends, price of all of that stuff. And a light bulb kind of went off, and I was like, holy crap, you mean you can make money with money doing nothing? And I was like, that's incredible. That's what I want to do. I want to make money.
Where's the strings? Where's the strings?
Yeah. And so I got I got kind of interested and excited about it. And man, I remember opening up Excel spreadsheets, and because this was before, yes, the internet was around. This is circa 1997. Yes, we had the internet. But stuff like investment calculators, if there was floating around, I didn't know them. So, I'm learning how to do the time value of money calculation on an Excel spreadsheet, and the carrot, and building basic spreadsheets to kind of see where an investment will go. If I invest, $20 a month, and that's what I started with. I started. USA had a special deal for cadets because they knew we were poor. You could start an automatic investment in a mutual fund for $25 a month. Normal minimum was $50, but they're like, you people don't have any money, which was true. And $25 a month was big money to me then, right? I'm a sophomore in college, making, what was it, $180 a month. Granted, my housing was paid for, but that was over 10% of my salary at the time. And then, so for the next couple of years through college, it, just kind of grew from there. My mom had a brokerage account, and so her broker, I of course told my parents I was doing this, and they were super supportive. And my mom's like, hey, let me introduce you to my broker. And so every once in a while, I went up there and sat in his office and opened up an account with him. And that dude taught me a lot about investing. And I was probably his worst client ever because and at the time, so my first couple of investments were stocks. And it was a $50 commission, right? I put a couple, I scraped together $1,000, which was, a month's worth or a year's worth of investing for me, and bought one stock, and it cost me $50 commission, right? But I learned a lot from him. And he kind of took me to that next level and talked through portfolio allocation and monthly contributions and all that kind of stuff, and filled in the rest of it. Once I graduated, it kind of at the point where I was looking for that monthly contribution. Now this is, circa 1999. Index funds were, ETFs were around, but not a lot, right? And so mutual funds had that nice added bonus of you can set up automatic contributions every single month. And so that was a lot of my investing, right? Was just plowing in, 15, 20, 25% of my pay into those. And so that's kind of where it got me to the middle of my journey, I guess. And so that's kind of my background in there. In a few times, obviously I learned a lot, made tons of mistakes like everybody. Learned from a lot of them, learned from hopefully all of them. But also got lucky too, right? I mean, I was super busy in Air Force pilot training during the .com crash. So I had automatic investments going in that whole time that I didn't even touch, look at, couldn't even tell you how much they were right now. Decent amounts. And then, so I was super busy learning to fly jets and probably drinking too much and in pilot training for a year and a half. And then, of course, follow that with 9/11, that was a long time of market declines that I couldn't even tell you how much my account went down because I was busy doing other stuff. So
that's kind of a blessing in disguise, though.
It really is, right? It's a lot of those challenges that folks face. I was busy, right? And I just happened to have investments going in. And that was always kind of my thesis. And I still believe this today is, when I say I'm not a dividend investor, I'm an investor, it comes down to three things, right? It's time, return, and how much you contribute. And then it's a math problem, right? And so for me, a lot of that was as I'm running, investment calculator, time value, and money calculations, in the beginning, the easier way to make that grow faster is to contribute more. And so a lot of that effort was, how can I squeeze a little more out of my budget to invest more? And so, there was a lot of years where, I was at the 25%-ish level pre-tax, not taking money. And other goals like maxing out your IRA, maxing out your Roth IRA, right, until I got income out of it. Maxing out your 401k, those mins are a little bit higher. Those are a little more difficult to hit. But I hit those and maxed them out for a decade. Jeez. Right? And a little on a brokerage on the side, right? On a military salary, so a pretty average salary too. But you do that for a decade and you'll notice it, right? You'll have an account balance that you're like, that's something.
Yeah. That's really cool. So I do wonder this, this is off the cuff. You were mentioning, I know back in the day that they used to charge, trading fees and
we
stuff.
used to do those calculations on an abacus and would run down the street with my stock certificate in my hand.
Yeah. Well, so for dividend stuff, you actually get a paper check. Like there wasn't, I don't know that there was a drip. Like you'd actually
drip was not a thing. And honestly, I can't tell you really when it became a thing. Cause again, I've never really considered myself a dividend investor. I've always considered myself an investor.
Yeah.
In the mutual fund and the entire time that I've been in the ETF world, it's always been an option, So I can't tell you when the individual stock world, when it became common with brokerages,
Yeah.
right? And over the years, man, I've went through, I don't know how many different brokerages. Some good, some bad. Couple of bad advisors. The guy that I learned from, he ended up retiring. Two other guys, a father and son duo, took it over. Then the father retired, so the son is still there. He's a little bit younger than me. He's kind of moved on from. He's a wealth management guy now, but they keep me because I've been there longer than they have.
Yeah.
And I'm good friends with him. He's a great guy. But every once in a while, a couple times a year, I pick up the phone and see what they're up to out there.
That's cool.
I have a long-term. My original IRA, Roth IRA, and traditional. The military or government's version of that, the thrift savings plan, I rolled into them, and that's it's probably about 55% of my portfolio. It's kind of my long-term, don't touch, don't do anything with.
Yeah.
I mean, not so much background, but it's there, and I can be more active in other areas. I don't have to worry about, that kind of piece of it. So
yeah. Well, so with drip not being a thing, or whenever it became a thing, and you have to be conscious of when you buy and sell because there are commission fees on all of those.
Yeah.
I wonder if that actually made people back then, like, people that are of a certain age that actually had to go through that. I wonder if it made them more prone to be buy and hold investors versus like today's generation where Robinhood and everywhere else is free trading. You can buy and sell as much as you wish, and it's no issue.
Yes and no. I mean, for all the hate that Robinhood gets, they gave us free trading, right?
Mm-hmm.
And it wasn't that long ago. I mean, I have an E-Trade account, and 5 years ago, E-Trade was a low cost brokerage, and that was one of the reasons I got them. At the time, I was still pooling together purchases because you're paying a $8 commission on it, right? Mm-hmm. And so to me, commission-free trading has been a huge thing. To get kind of to your answer there, or your question, back in the day when you were paying big commissions, it was a lot to pull the trigger. Mm-hmm. And you have to scrape together a decent amount of money. I mean, $50 commission on $1,000, that's 5% off the top.
Well, and you couldn't, it wasn't even really, from what my dad was telling me before, is like you couldn't even, there was no fractional shares, and two, exactly. You had to buy lots of shares at a time. So you would have to go in there with bigger chunks of money.
You can buy a share, but you buy $100 share and pay a $50 commission.
Yeah,
right?
It wasn't worth it. Yeah.
Yeah.
Yeah. So yeah,
I mean even with low cost brokerages, a few years ago, USAA, my first kind of self-directed brokerage was with them. I think they were at $7 or $8. E-Trade was a low cost brokerage. They were at $6 or $7. Mm-hmm. So if you care about, on $100, that's still what, 7-8% or 6%, if I can do math.
Yeah.
That you're taking off the top. So that's a thing. I mean, nowadays with commission free, you can put limit orders in on, for one share of something.
Yeah.
And I think it's awesome. I think we are definitely in the golden era of investing.
Yeah.
There's a lot of awesome opportunities out there with fractional shares. E-Trade does automatic investing in ETFs now. To me, I think that's huge. I think it's a game changer. $25 a month, weekly. Down to, so you can, somebody that's putting in, $400 a month, $100 a week, you can have 4 different positions that are buying at $25. Mm-hmm. To me, that's pretty cool.
You can do that on Robinhood too. I started with Robinhood, and you could do that on Robinhood where you can set it up where I'm going to add this much money to the account, and I want this much of that money to go into this stock, this stock, this stock, and it just does it automatically, which is like you said, it's the blessing in disguise. And Charlie Munger says, often the best thing to do is nothing.
Yeah.
And you just literally hands off. And a lot of times you get in your own way when you start touching stuff. So you're better off not to.
Even now, obviously, I have way more time to spend investing, and I love it, right? It's somewhere along the line, it became a hobby. Absolutely love it. Love talking about investing with folks. Love the Facebook groups most of the time. And talking investing with people in real life too. But yeah, I mean, it's, the U.S. financial markets, they're the greatest wealth creator in the history of wealth creation, right? It's incredible.
Yep.
You look at folks and you go, hey, that dude's rich. Why is he rich? Well, he's rich because he owns shares of stuff.
Yep. I mean, Warren Buffett. Look at Warren Buffett. He's not rich because he's some genius. He's rich because he's been doing it for a long time.
And he's interested. I mean, I was born, or I grew up in Nebraska, so I consider myself a fellow Nebraska with Warren Buffett. I think he's a great dude. But you look at, if you dig back into the history of Warren Buffett, and he's incredible, no doubt about it. But you look at where he was in his 40s, and he wasn't uber rich, right? In his 50s, he wasn't uber rich, and his investing style has changed. And that's, as much as I love looking at those guys, I think one of the mistakes with Warren Buffett is there's dudes that are in their 20s and 30s that are following Warren Buffett's advice where he's in his 80s and 90s.
Yeah. Yep. Completely different.
They're not looking at what he was doing when he was 20 and 30.
Yep.
He was out scrapping together investing when he was 17, 18, 19. That's a great idea, right? Be 17, 18, 19, go out and get a little bit of money, do a lemonade stand, mow some lawns, boom, put that money to work, right?
Yep.
Start learning. I love time in the market. I think half the value of time in the market is learning from that, right? I mean, putting real money towards it. That's the best way to learn.
And for the people watching, he didn't say timing the market. He says time in the market. That's very different. Sounds the same, very, very different.
And that's, basic philosophy, that kind of the way I look at it is, for me, what I'm trying to do as an investor, and what I think individual investors should do, is I'm taking a portion of my salary and converting it into a portfolio, right? And so when I talk time in the market, earn it, invest it that month, right? That week maybe. I don't kind of drill down more than that, but it's, if the market goes down, even if you guarantee me the market's going to go down next month, I'm going to invest this month on the off chance that it doesn't.
Yeah.
Right?
There's so many people are like, we're going to have a recession. I'm like, yeah, well, everybody makes predictions, but everybody's only famous off the one they get right. Nobody keeps track of how many times they were wrong.
Exactly. And even, you don't have to go back that far. I mean, you look at October and how many people were calling, 3,000 to 3,400 on the S&P. I mean, the S&P was down below 3,500 for like an hour and a half or something. Nobody was talking about, they're retesting the lows, market's going down another whatever. Even my brokerage guy, when I talked to him, he was like, dude, if the market goes down 20%, it's going down 30%. And you look, and that's kind of bears out.
Yeah.
So I was like, yeah, that's probably not the low.
Yeah.
Turns out October is kind of looking like the low. You look at end of the year, right? And nobody was talking about a huge bounce on the other side of it. You look at what the market's done, February, when it rocketed up, early February, everybody's like, no, bear market rally. We're going to retest the low.
Dead cat
and
balance,
I saw the math on it, right? When you look at the earnings math in that time, we're retesting the lows. Turns out we have, and we're probably not. I mean, if they manage to pull off the debt deal, there's not a lot of bad news left hanging around.
Nah, stay tuned. Somebody will come up with something.
Yeah. And so, I always I'm going to stay 100% invested, right? You'll never miss a rally if you don't have money on the sidelines. I love market sayings. One of my favorites is, you got to be in it to win it, right? I think that's Stephanie Link. That's hers. I stole it from her. My personal one is, second string sits on the sidelines. I made that one up. You can use it.
Thanks.
But
I'll give you credit.
I mean, you'll never miss a rally if you're fully invested.
Yep.
And that's an easy way to win it, right? A lot of a lot of the times when people, aren't doing well investing, it's mistakes, right? And it's every bear market, you'll find somebody because it looks like the market's just, catching that fallen knife, that there's no end of selling, right? And so somebody will just say, look, I'm selling here because at least I got what I got. And then the market goes down a little bit more, and then it rockets up, and they miss 2/3 of the rally.
Yeah.
So.
Yeah. It's a big emotion game. I've had a couple of videos where I talk about that. If you can control the emotions and stuff, I think instead of the government raising taxes and stuff, why don't we just do like a pay for prediction? And all these people that have all these predictions that they want to make thousands of per year, you have to pay for those. If you're going to worry about, oh, we're going to go down this month, and then we don't go down this month. Don't worry, it's coming next month, and it doesn't go down next month either. And then eventually they get one right, and now they're a genius. I'm like, okay, well, they're batting, like, they got 1 out of 1,000 right. Are they really that smart? Like,
Michael Burry, right? He killed it on that one prediction.
Yeah, exactly. How many has he got right since then? Like, he's probably.
And even then, the predictions aren't bad. I mean, there's smart people that are doing them, and they're well researched predictions, right? I mean, when you looked at the market retesting the lows, you do the math on S&P earnings, and it looked like basically a guarantee until you see what the S&P earnings actually do. And so to me, the market's priced right based on everything that we know now, right? The market moves on professional investors. It's not guys like you and me, putting in whatever we put in a month, right? Putting my little buy order in there. That doesn't move the market. The market moves by large professional investors. It's a voting machine.
Yeah.
Right? Dudes all over the world putting in big money. That's what moves the market. And when you mention the psychology of it, that's what it is, right? We're not, if investing was just picking good companies, it would be a lot easier and a lot more boring. Right? What it is we're trying to pick the companies that everybody else is going to think are awesome. And so the psychology behind it, if you're going to be a successful investor, that's a big piece of it, right? Because, even if you look back to October and everybody hit the sell button, did the market really need to go down to 3,500 on the S&P? I mean, here we are today, right? It's at 420, closed above, or 4,200 on the S&P. Did the market really need to go down to 350 or 3,500? I don't know. Not really, right? Here we are.
That's a good buying opportunity is what it is.
It was, right? And they're hard to tell. I mean, hopefully, I ended up investing more money last year than I ever have in the history of investing. It was something like 47 or 48% of my salary.
Very nice.
I get paid a little more now than I did when I was in the military. And it's tough, right? I mean, I was plugging in buy orders like crazy, spreadsheets, and I mean, did I buy during the bottom? Absolutely. Did I buy on other times? Yes, I did. I mean, I remember, I can tell you what day Russia invaded the Ukraine, 24 February. Why do I know that? Because I had a bunch of buy orders in, limit orders in, and the minute the market opened up, they were flying out of there, and I thought that was the greatest thing ever. I'm like, I'm a genius. Then fast forward to July and October, you go, holy crap, I guess that wasn't so good. Now today, I mean, they're up 4 or 5%. In what, 13, 14 months.
It's all relative. And I try to really, I have a lot of friends or other people that I talk to that are like, they get really worried, or they'll contact me and say, hey, Troy, I hear about this. What's going on? I'm like, well, answer the simple question. Do you need the money today or tomorrow? And if you do, you shouldn't be invested. But if you don't, who cares what happens today?
And that was back in 2008, 2009. That was kind of my lesson learned during that little bear market. Is that, everything went down and a lot of things happened. Some life changes. I almost got out of the military during the time. I wound up moving from Hawaii to Kansas, which was that was a little bit of a change. But I wanted to buy a house, and it was, I'm looking through my portfolio, and I'm like, everything is down. Now, fortunately, I didn't sell anything.
Yep.
But it was like, man, I'm really, really scrapping together to try to find a down payment in there to go off and buy a house. And I bought a great house, and I thought, this is perfect. I'm buying it after the largest housing crash in the history of housing. And fast forward 5 years, the housing market in Kansas went nowhere. That house was basically flat. You look at what the market did 2009 to 2000, and when did I sell the house? 13. Over those 4 years, the market skyrocketed during that time.
Yeah.
So kind of another lesson learned there. I love houses, but houses are easy to come by.
Yeah.
They really are, right? Large investment portfolios, they're a little harder.
Yeah,
Takes a little
exactly.
bit more time there.
Yep.
Right?
I agree. Okay, so I mean, you kind of spoke on this a little bit. So if you had to classify yourself as a type of investor when you first started, what would you say you were?
I don't know, an investor. Like I said, I got started with a guy that ran a brokerage that taught me about investing and kind of filled that in and taught me about portfolio construction and allocation and those kind of pieces of it. And so that's how I started. And so my portfolios have always looked like professionally managed portfolios, like your 401k looks. A little more, I think, better. At least a little more breadth to it. Mm-hmm. But I thought that's the way everybody invested, honestly. Yeah. I didn't know there was other options. And then, several years ago, because I enjoy investing, I enjoy talking investing. It's like, wait a minute, there's probably some Facebook groups out there. Mm-hmm. And so I joined some Facebook groups, and I was like, holy cow, there's, people that are investing different.
Yeah, not wrong. They're just not.
And it's not wrong, right? Yeah. I mean, part of it was, was a learning experience for me of, hey, what are these what are these people doing? And then it's like, okay, let's look into that, right? Mm-hmm. And what's some lessons to learn, right? I believe in being a student of the market every day. And so just because somebody's doing something different, right, I'm going to look into that. Mm-hmm. And I'm going to see, do they have something that I can learn from, take, use? So yeah, there's been some good little nuggets in there. There's some other stuff that I'm like, I went through my yield chase phase too, where you're like, oh, all I got to do is sort for yield, and highest yield in there, boom, you buy that stuff. I owned SDIV back in the day, held it for I don't know how long. And, then 4 or 5 years later, you're like, wait a minute, this is worth the exact same that it was, when I bought it. And at the same time, I bought the NASDAQ, ONEQ, the ETF, and it's doubled. And you're like, huh.
Yeah.
One set of money went nowhere, and one set went, doubled the money.
Yeah. Well, and where you
and even beyond that, just to fill it in a little bit is, I still remember this today, where it was like, I read an article, and it was like 40% of the S&P's returns over the past how many ever years. Hold on, there we go. 40% of the S&P returns are from the dividend yield. And at the time, it was yielding 2.4, 2.5. Mm-hmm. And so you're like, holy cow, if it's 40% of those returns, and those are double-digit returns, right? This is circa 2000, probably 19, 18, 17. It's still putting in 10-year double-digit returns. When you go, shoot, if I can find some stuff with 3.5%, that's even better, right? Is it? Kind of, right? Yeah. Not so much. And so that's kind of what got me into a few more of the dividend ETFs. Was, I guess, a little bit of a yield chase, which was good because, I bought SCHD before it was cool, back in 2017 or 18.
Yeah.
I don't remember in there, but it was like, I don't know, 50 some bucks a share or something like that. But it was good to see over that time how that stuff performed. Mm-hmm. Right. So there was a learning process in there. Is there a magical number on yield? I'm not sure there is.
Yeah.
Right.
I'm actually going to work on a video on that. Like, I don't know that there is any magical numbers, but I'm trying to figure out if there is a certain combination of dividend metrics in combination with capital appreciation, the dividend yield or dividend growth rate, and whatever other numbers that would better fit not necessarily people's age, because age doesn't really matter, but necessarily their timeline till they need the funds. Because like I can be 20 with the goal of retiring at 30 and I have 10 years, or I could be 20 with the goal of retiring at 60 and I have 40 years. So really the where the finish line is matters more than the age.
And a lot of it has to do with what the market does, right?
Yep.
I mean, when you look at times where the, March of 2020 to the end of 21, where the market goes straight up, those are price appreciation times.
Yep.
Right. Do you want to miss out on those? Maybe, maybe not. You look at 2022 and boom, all of a sudden dividend funds are holding in like a champion. Right.
Yeah.
And so, I've always had those pieces out there because I want something that performs well in every market.
Yep.
Right? Kind of one of those lessons learned from 2009 is no point in having money if I can't use it. Right. More so in non-retirement accounts, but I want to have enough diversity in there that if I need to tap some money, there's something in there, right? And if the market's up, right, I can tap an equity fund. I can tap a growth fund. So, when I look at emergency funds out there, anything's in play. I don't keep money in savings. I keep a little bit. I keep a couple of paychecks, right, for a pay hiccup. But beyond that money is invested, right? It can do double duty. Yep. It can round out equity positions, bonds. I know, we just had the worst year in bonds in, 250 years or something since the bond was invented. I think the danger right now is people will get a skewed view of bonds and fixed income. Going forward, it looks great, right? They're yielding awesome. We're probably going to have interest rate cuts, and you get price appreciation. So bond market last year was horrible. Bond market looking forward for the next, 20 years probably looks pretty good. So.
Yeah. It's all about that diversification too. And like being diversified, not only through sectors and different holdings, but it's also, like you said, you have your growth plays when the market's going up and up and to the right, like we all like, but then you also need those income plays, the yield plays and stuff, and the safer investments for when the market is trading sideways or going down a little bit. It can help you minimize the losses or maybe even negate them and keep you even. And if the market's down 10%.
Where those dividend funds, I think, where they do kind of keep that return in there, is, even on quarterly dividend payers, they're buying during that time. And with dividend reinvestment, you're getting a really good price a lot of the time.
Yep.
Right. Because the price goes down a little bit, goes down roughly about the dividend amount. And so when you stack that together over the course of, 3 or 4 years, it's reinvesting the dividend at a really pretty great price. And so on those little portions of it, you get some kind of outsized returns. And so even without a lot of price appreciation, you still get a decent amount of total return from it. Yeah. And in years like last year, where they don't go down as much because there's kind of a flock to safety a little bit, they hold in there, right? I don't know what, most of the dividend funds were, how much they were down. You look at the Dow 30 was down very little last year. NASDAQ and Russell 2000 were both down more than 30% each. That's a big hit, right? 30 your money disappears.
Yeah, exactly. Okay, so next thing I want to go into, and I know you said you're just an investor in general versus the dividend investing, but when you are in your investing journey and you go through those ups and go through those downs, what keeps you going? What keeps you motivated through the whole process?
That I guess what's changed for me now is I know it works, and I can remember. Even having been invested for 10 and 15 years going to investing classes and trying to take those opportunities. And I still remember asking that question of, what if this doesn't work? What if I get all the way to the end of my my career and turns out, automatic investing into indexes didn't work? I got to plug my computer in here.
Because there's no redo on that, right? Like if you
exactly
spent
right
20, 40
there's
years,
no you don't get a chance to do it over again.
And that is scary. I know a lot of people that are just like that, where they're trying to, do the right thing, well, more or less the right thing, and invest and put their money away where it needs to go. And then you do get to the end of the road, and you fingers crossed, you hope it worked, because you don't get those 20, 30, 40 years back.
Counting on you to do some good editing on that part there. So that was kind of a big change, was, what if this doesn't work? And so, and again, some of there I was, had been investing 15 years. That's what has kind of changed for me now is confidence in my portfolio. And it's not, it's not amazing. And in a lot of ways, that's why I like vanilla index funds, right? And I don't just own those. I've got other stuff, interesting stuff out there. But I know for a fact that, 20 years ago, people were talking about the S&P 500 as a great investment, right? Warren Buffett won a bet against hedge funds against it. Everybody, talks about the S&P 500. And it's a great, great, great option. 20 years from now, I'm pretty confident that people are going to be recommending the S&P 500.
Yeah.
Right?
There's a reason it's a benchmark. There's a reason everything's compared to the S&P 500.
And the flip side of that is 2009 to 2021, into 21, large cap US has outperformed, right? And so you have to have been investing for quite a while to see other areas of the market, right? Small cap US, international developed, emerging markets. If you've had any international exposure since 2008, it's been tough, right? There's single digit returns. I think the flip side of that is folks that are 100% large cap US, and a lot of individual stock investing funds that I see on Facebook or in real life, folks are 100% large cap US, right? Very little small cap, very little international exposure. During times when those outperform, it's nice to have a little exposure in those areas.
Yeah, I agree. Okay, so I ask everybody this question because I'm hoping, I hope I get an answer that changes my life. So again, no pressure.
Okay.
So with dividend investing, I invest mostly in dividend stocks in general. But I do a lot of low yield, high growth, or capital appreciation that just also happens to pay a dividend. Your Apples, your Microsoft, stuff like that.
Is that dividend investing? I'm still curious about that.
Yeah.
As long as it pays a dividend, that qualifies. Then?
Yeah, hey, you're technically NVIDIA qualifies as a dividend stock, even though their dividends gross. So okay, so
I have a question on that later.
Okay.
We'll get to that.
Okay, so my question. So for me being competitive, and if you want to call it greedy, I know that I've ran the numbers. I know what my portfolio should get me by the time I need it. Let's just say $60,000 for funsies. That'll be enough to cover my expenses. Hopefully the mortgage is paid off by then. I reduce my expenses, therefore I have plenty of money to live off of. But due to the dividend snowball and due to compounding and how that works, you're going to have year 22 when I'm 50 years old that will pay me $60,000. And then year 23 might pay me $68,000. And then year 24 might pay me $80,000. So how do you know when enough is enough?
Well, a couple answers to that. Are you a math major? I'm not a math major.
No. I'm just a guy that spends too much time on the internet.
I just didn't want to embarrass myself. A lot of investing is math, right? Which is cool. I've kind of rediscovered math. In high school and college, it sucked. And I remember getting a lot of extra instruction from my math teacher. Now it's cool. Now there's a purpose to it. Anytime we start talking exponential growth, the farther you stretch the timeline out, the more those numbers get weird, right?
Yep.
In any exponential growth graph you see, the end of that graph is going straight up.
Yeah.
Right.
Yep.
It's approaching infinity. And so it's good, right? I mean, I remember, being a 19, 20, 21-year-old and plugging those, and even conservative numbers.
And you were going to be a trillionaire.
And you're like, dude, this is how, when you ask how I got started, my original plan was I'm going to retire from the military at age 42, 20 years in, check for life with $1 million. I missed the $1 million by 1 year. Pretty close.
Yeah.
Which I'm actually kind of impressed about. But then I was like, wait a minute, you can't retire on $1 million. I ended up retiring from the military before then, which was cool too. But with any type of exponential growth, dividend growth rates, portfolio values, anything where it's exponential growth, the farther you stretch it out, the less accurate it is. And I still do it, but I also do shorter terms, right? I look at, one of my favorite looks is a 3-year look. Because the market generally is not down in back-to-back years, right? And so to me, a 3 calendar year look, quarter to quarter, whatever, is kind of my short-term look. 3 and 5 years, I like those calculations because they're fairly accurate, right? My portfolio doesn't change a lot over that time. And so a lot of times I'm doing those calculations looking forward, right? Portfolio doubles about every 5-ish years. And so that's kind of the way I look at it. You can get some pretty crazy numbers at 15, 20, 25, 40 years, right? I mean, you can do hey, if you start investing when you're 1 year old and you invest $1 a month, you're going to be a millionaire 75 years down the road. There's a few kind of problems to that, right? $1 million 70 years from now is not going to be $1 million.
That's like 200,000 today.
Right. And so the farther you stretch out the math, and Chad's had a couple of those, right? Where he's talked about it a little bit of, the math gets weird.
Yeah.
That's one of the things I've kind of noticed in dividend groups is people overestimate the dividend growth, right? You look at Coke, right? Coca-Cola, it's a great company, 62 or 3 years of dividend growth. It yields 3.6% and pays I don't know, whatever the dividend pays. But 62 straight years of dividend growth, it has a 3.6% yield. So when guys are like, oh yeah, this dividend fund or this dividend position 30 years from now is going to pay me 17%, I doubt it.
Yeah.
Right.
Yeah.
You look at all of the big dividend names and whether it's funds, whether it's individual stocks today, they pay 3 to 5% a lot, right?
Well, I think they're counting on their yield on cost more there, I think, is like.
Yeah, so I'd never heard of yield on cost before. And so I was like, oh, wait a minute. Let me look at this yield on cost thing. The only thing I'm kind of against yield on cost is my kind of thought process is a 20-year-old, a 40-year-old, they shouldn't have the same portfolio as a 60-year-old, right?
Exactly. Yeah, true.
And I'm really starting to look at retirement portfolios. I'm, depending on when I want to retire, for 13, 14, 15, 16 years, right? Close enough that I'm like, you know what? You've been concentrating on growing portfolios. Maybe you should start thinking about income portfolios. And so I'm kind of starting to mess around with it, and it's been interesting. But I mean, you look at some pretty crazy growth rates, and the number starts to get weird, right? And so the yield on cost thing, if I buy a position, doesn't matter what it is, and then 15 years down the road, my yield on cost on SCHD is 7%. I calculated it one time because I was curious. And I went, wait a minute, it doesn't really matter because I don't care. I want that money to grow. to return to double, right? Like I said, I mean, I look at total portfolio, doubling every 5 years. I don't care what my yield on cost is, because 14 years or 20 years, whenever I retire, I'm rebalancing that portfolio.
Yeah.
And so when I'm looking at income portfolios, I want safe, stable income, right? I don't want that the capital to get eroded away,
Mm-hmm.
right? And so I want to see a return about what the yield is. I want that steady income that's there forever, right? And so yield on cost, I don't really care, because my portfolio is going to look different then, right?
Yeah. Well, I
I
think
have positions in a lot of that stuff just because I want to learn about it, right?
So I know with what Chad does is Chad hopes that he's buying stocks that's focused on total return, like the total growth investing, which encompasses low payout ratios, high dividend growth rates, and obviously capital appreciation. And the yield on cost would end up being, okay, say you need a stock that's yielding you 6, 7, 8% in retirement. Like that's something that you would like. It's a capital appreciation stock and it's also yielding 6, 7, 8%. If you can buy a stock that is, let's just say Apple or Microsoft, that have like below 1% yield. I think both of them have below 1% yields. Both of them are below 1%. You're not living off of that unless you got millions and millions of dollars. But pretending you don't have millions and millions of dollars, if your yield on cost gets up to 6% with Microsoft, in theory, you wouldn't need to sell it, because instead of selling Microsoft, which is a capital appreciation and now a 6% yield for you, you would be able to hold Microsoft, and then it's instead of rebalancing, you can just keep that position.
It's 6% yield on whatever your initial investment was, right?
Your total investment. Yeah.
Yeah. And so to put some numbers to that, let me think about this.
Because I'm not even at the point where I care about yield on cost yet. I'm just investing.
If you were to change that, I guess kind of the way I always look at it, again, I'm an index fund guy, right? And I look at, very low yield, something like the triple Qs, right? QQQ, QQQM, whatever.
Yep.
Pays, it might even be less than 1%. It pays one something, I think. If I own that for 30 years, right, and then sell that off to something else that has, a higher yield, and yields on ETFs are kind of hard to come by, right? Over 4% is pretty rare.
Yeah.
But they're out there. To me, and if you run the math, you're better off selling out of that QQQ position, even though your yield on cost may be great, even though that yield on cost may be equal to a different fund, but the value of that position has went up a ton, right? And so to me, the yield on cost thing, it's not really a thing for me.
Yeah.
Right? I'm looking to grow that amount. And again, like I said, I got started, I wanted to retire early, right? I know you're a retire early guy. I think that's awesome.
Yeah.
Because it gets guys investing, and it gets guys serious about investing, right? Because you're like, dude, I have an end date in there. Now I'm not so much a retire early guy. The flip side of that is your 40s and your 50s. Those are for most people, your big earning time frames. Mm-hmm. And your standard of living changes, right? And so now my retirement goals are considerably loftier. At some point, my portfolio, it's not quite to the point where it could replace my salary. And of course, being able to tap retirement accounts is kind of a thing in there too. But it'll get there before I hit retirement age. Mm-hmm. And then, it's always nice to have that option where you can decide to retire early. But back to your question, is those numbers will grow a lot.
Yeah.
I was sifting through some old investment data today as I was kind of thinking about this. Where did I find it? Yeah, March of So March of 2009, that's kind of the bottom of the great financial crisis. I was at 135,000, a little over 135,000 in my portfolio. October of 2007, which was kind of close to the peak, I was at like 171.2. That was a pretty big drop. I'm pretty close to 10xing that, 1.3, a little over 1.3.
Well, so that's a pretty big drop, and that's with you adding money throughout that whole thing too.
Yeah. So here's another crazy one, right? I looked at, because I said, hey, I like the 3-year look. And I was like, do a 3-year look to today, right? Go back to end of May of 2020. And I did a lot of changes to my account. And there was some consolidation. Today, I think I have 9 different accounts with 4 different companies. That's after consolidation. It was way worse than that.
Yeah. You said you love investing.
There's a lesson learned there, and I'm happy to talk through that if you want, because there was mistakes made and lessons learned. But yeah, so I went back and looked, and it was like, where was it? 2020. Yeah. So 21 March, which was right before. It was like 2 days before the bottom of the COVID bear market. I was like 686,000. 19 May, which is as close to it, 846. I was like, there's no way that number's right. And I looked, and it is. The market moved 27% in a couple of months off of that low. And so part of it, my portfolio changes in value in amounts that I didn't think that I would be.
Yeah, nauseating amounts.
Right. And so, back in the day, somebody's like, dude, you're an aggressive investor. I was like, I am not. I like mutual fund, index funds, mutual funds, and automatic investing. I'm not an aggressive investor. Like, dude, there's always, like you kind of mentioned before, there's always some bad news out there, right? Mm-hmm. One of the things that I did right, and a great lesson learned, I plow money into the market like it's guaranteed to return 10% a year.
Yep, that's what I do.
Because it will, right? It'll average out. And if it doesn't, if it's 9%, well, that sucks.
Yeah, we're looking for an 11% next year then.
Or it's an 11. And when you look at years, right, I like looking at annual returns on the S&P. They're all over the place. It never returns 10%. Right? Mm-hmm. It returns -1, -30, +32, +23. And if you go back and look at those, nobody ever predicts those, mm-hmm. right? Nobody ever goes, well, the S&P is going to return -4% this year, right? Or it's going to return 32% this year. And so to me, all those predictions are wrong. So I'm going to stay in it, right? I'm going to plow money in every month like it's a guaranteed 10%. And I'm going to look back, and you know what? It averages out something kind of close to that, right?
Yeah. Yeah. That's a really good approach. Okay. So, I mean, you mentioned a lot of things about like lessons learned. So if you have anything dividend related here, that would be good. If not, just in general.
Don't chase yield.
Yeah. What is the biggest dividend mistake you made, and what did you learn from that mistake?
Chasing yield. It really was. Because again, like I said, I learned, hey, 40% of the S&P 500 returns are from its 2.5% dividend yield. So more dividend yields got to be better than that. Not so much. Mm-hmm. The flip side of that too is you can't chase return, right? If you go out, you can make the same mistake on price appreciation. Mm-hmm. You can sort for ETFs and find out which ones return the most, and you can chase a return. It also doesn't work. I've done that too.
Yep.
I wish I had a great answer of how to not do the two of those things, right? Some of it, you just have to do the best research and try to predict. And again, you're not predicting which companies are going to, whether you're an index investor or a stock picker or whatever, you're not trying to pick the best businesses, the best basket of ETFs out there, right? You're trying to pick the ones that investors are going to buy the most of. Mm-hmm. That's what drives your return.
Yeah.
So
That's a good way to
look
look at
darts at a dartboard sometime. Yes. And that's why I'll tell you what, as much as I think about this stuff, what do I keep coming back to? Automatic investing, in a balanced portfolio.
Yeah. Yeah.
Because
I mean, those are all good points. And like, I've never heard it put the way that you just said it about like, it's not necessarily picking the best company. It's picking the one that everybody else thinks is the best company, which I mean,
picking the company that Warren Buffett's going to pick 2 years from now.
Yeah, exactly. Yeah, when you get into Occidental or whatever, those are the ones.
Wait till he buys Nvidia.
Yeah, just wait. Yeah, you thought 25% was a run. Just wait.
Yeah.
Okay, so next one. So I'm really curious your answer on this one. So what is your biggest selling regret and your biggest buying brag? So what stock did you sell and you wish you wouldn't have, and which stock did you buy that like nobody else gave it a chance and you were right?
So a lesson learned there. I remember back in 2004-ish. Again, like I said, I have owned individual stocks back in the day. I bought MCI WorldCom back in the day, and then when it got kicked off the S&P 500, I bought a bunch more. I tripled or quadrupled my position into it. Fast forward a couple of years, they went bankrupt. I lost all my money. The CEO got thrown in prison. That was the last individual stock I bought.
Well, there you go.
That got me out of the stock picking world. In terms of everything else, it's the vanilla funds, right? I mean, right now, I have weeklies going in on QQQ, ONEQ, the NASDAQ, the S&P 500. I noticed the S&P 500 wasn't the largest holding in one of my accounts. And I was like, you're an index fund guy, right? Why is the S&P 500 not your largest holding? Are you really that smart? Turns out I'm not. The Russell 2000, right? The Russell has gotten hugely beat up in the banking crisis. Hopefully there's a pop in there. But so what's the greatest stuff I bought? Those.
Yeah.
Because long-term, right, more than 10, that's the thing. If you go back 10 years ago, 2013, the market doesn't look a lot different than it does today, right? Mm-hmm. You look at the companies people were talking about or investing in, they're kind of fairly similar. Guys were loving Apple and Amazon, right? Microsoft even. You go back 20 years, the market is very, very different.
That's
right?
like IBM and
IBM,
yep.
GE, yep. GM,
Ford,
and Exxon, right? Yep. You have an Exxon position, yep. right? Yeah. So that to me is kind of that lesson learned in there is, Exxon was great 20 years ago, and it's still great today. There's a bunch that aren't. IBM, General Motors, Ford.
How was AT&T back then?
People thought that was a great company.
I feel like AT&T's been flat since it existed.
No, man. If you bought AT&T in 1903, whenever the shit was open, you've been great, right? So that's, I think, the challenge for investors is, even if you're like, man, 5 years is a long time, 10 years is a long time, it really isn't, right? It's weird market cycles tend to be longer than that. And so there's some lessons learned that even if you have been investing, even if you went all the way back to 2007, 2008, 15 years, you've missed out on a lot of investing lessons, right? Because it's been a large cap US market. Now, if you would have asked me in, October, last October, last December, hey, do I think large cap US tech is going to lead us out of this bear market? I'd have said no. Turns out today, right?
Yeah.
Large cap US tech is killing it. NASDAQ, I just looked today. NASDAQ's up 24% this year. Triple Q's up 30% year to date.
Hey, good thing you don't have to pay for those predictions.
I would not have predicted that.
Yeah.
But I own both of them.
Yep.
Right?
Yep.
I've got positions in both of them. I've got XLK position, right?
It's a good thing you were wrong then, right?
And that's a big lesson learned for me is predictions are wrong, even mine, right? And so I don't hinge my portfolio decisions on those predictions, right? I like something that's going to work regardless of what the market does. Keeping a balanced portfolio, staying 100% invested, that works all the time, right? Yeah, you've got to be able to stomach those drawdowns. As long as you can do that, right? As long as you can watch a third of your portfolio disappear, and wonder, because again, once a third of it disappears, nobody goes, "Hey, don't worry, guys, that was it," right? No. They're talking about another 20%, right? You're talking about going down 50. You're talking about going down 60, right? Because nobody ever calls the bottom unless you're what's the guy, Mark Haynes, that famously called the 2009 bottom. He's like the only guy that's ever done. And so when you're at those lows, those depths, the news is the worst. And so you got to be able to kind of stomach those and keep plowing money in. And if you're plowing money in, like the market's guaranteed to return 10% a year, go 3 years down the road. And 3 years isn't that long, right? That's the other tough part for investors is depending on how old you are when you start investing, you're going to have 30 or 40 years to grow your portfolio, right? And so when you're like, hey, I've been investing, pick a time. And I'm not, trust me, I was new and I made tons of mistakes out there. But when you go, I've been investing for X long, dude, that's not 10% of the time that you're going to invest before you retire.
Yep, true.
When you retire, right, whether you retire at 50 or 55 or 60 or 65, you're going to live another 40 years probably, right? So you're going to have another 40 years investing as a portfolio manager, right? Living off of that income. So you're going to have a lot of time investing. And so for newer investors, I try to have them keep that time frame in mind, right?
Yeah.
Of where are you on this journey?
Yep.
Think about how much you'll know, right? Because again, like I said, I try to be a student of the market every day. I love learning about this stuff, and I doesn't matter who it is, right? I've caught stuff in your videos where I'm like, dude, that's interesting, right? There is nuggets of learning and information out there that you can find.
Yeah.
And put all that together.
Yeah, that's very true. It's one of those things that one of the hard parts about being young and in investing is you're often asked to do things for your future self. That's like say I'm 20 years old and you're asked to do things for your 60-year-old self. That's 40 years from now. That's double as long as that person's lived.
Yeah,
and you're wanting me to make predictions.
Right?
Yeah, you're just like, I don't even know what 40 years feels like. I'm only 20.
And I'll tell you too, I mean, there's folks in the FIRE movement that are saving 40, 50, 60% of their salary. I've never been that guy. Even though I was kind of hey, I want to retire early and buy a boat and do all that kind of stuff. Turns out I'm not that great a saver. Yeah, I mean, I like motorcycles and guns and boats and airplanes and a whole bunch of other stuff that's expensive. For me, I topped at about 25% of my pre-tax, not my take-home. That's about as high as I hit. But I was at 20 or 25% for the majority of my life. And the math gets kind of interesting there, right? Because if you're looking at when you're going to retire, and this is a little more for folks that maybe didn't get that early start, is if you're saving 20% of your income or 25% of even your take home, you really only have to replace 75%, right? You're living on 75%. And so even small changes in there, the difference between 20 and 25% is big. Of course, if you're, so anyways, yeah, you can not save a ton and still go out and spend a lot of money and enjoy your time. And I encourage dudes to do that on a Facebook group where people are like, oh, I don't like to spend money. And I'm like, what's the point of being financially responsible. Here's Justin giving bad advice. What's the point of being financially responsible if you can't enjoy it, right?
Yeah.
I'm like, dude, have you ever ridden a red Italian superbike? I'm a huge Ducati fan. I bought mine used, right? I didn't go out and buy a brand new one. I bought it for half what the guy bought it for new. But it's the most silly, impractical thing ever. But I love it, right? And so when you're investing, people that are start out and they're piling all their money into it, I'm like, dude, you're probably not going to stick with it.
Yeah.
Right? 2, 3, 4 years in, you're going to be like, I want a new truck. If you can balance it, right, then you'll stick with it, because that's what investing is, right? It's the time factor is what gets most people. That's what a college degree is. Proof you can stick with something for 4 or 5 years.
Yeah.
Investing is that over
your life,
decades.
Yeah.
Right. People go, hey, how do I make $1 million? How do I get a 7-figure investment portfolio? Well, you invest, how much money do you have now? You invest X amount a month for a conservative return, 9% return, 9.5% return for 2 to 3 decades.
Or you rob a bank.
Boom. Or you rob a bank. But the math works, right? It's guaranteed. It comes down to those 3 numbers. I believed it for years, and then I figured out that it actually worked.
Yeah.
Right. Been there, done that, check the box. Right. Now we're moving on to bigger numbers.
Yeah.
And people ask that question, what's the hardest? Because I'm all about those milestones, right? Whatever yours is, 50,000, 100,000, 250,000, 500,000. I looked mine up. I found one of those. When was that? 2015. Somewhere in 2015, I hit the $500,000 point. And then in 2017, January 2015, it was 488. January 2017, 556. And I went, that's horrible. 2 years. And then I looked at it today. The market did 7%. That's about a 13.5% return. That's with contributions, right? 2-year period where the market didn't do a lot, portfolio still went up in value. But yeah, so I'm all about those milestones there. The first one of any of those is the hardest.
Yeah.
Right. I mean, it took me, 2015, I started in 97, 15, 18 years to hit $500,000. The next $500,000 came in 5 years.
Yeah.
Less than 5.
I mean, it's Charlie Munger that says that your first 100,000 is the hardest to get, right?
It's the first number, right? Yeah. Because now you've got a lot of portfolio behind you helping you. Took me 24 years, to break $1 million. The second one hopefully is 4.5, 5.5 years.
Yeah.
Right. Not 24 years.
Yeah.
So yeah, I don't, the first whatever isn't, they're all hard.
Yeah.
Right.
True.
Whether it's $1,000, whether it's $50,000, whether it's 100, 2, whatever. Those are good, important milestones though, whatever yours is. Right. And honestly, that's kind of my other lesson learned, and why I'm happy to share with people is, at the bottom of a bear market, you can 10x your portfolio. And I had a $135,000 portfolio in 2009. In 2009, that still wasn't that much money, right?
Yeah.
There's a lot of people with $100,000 in the market. You're 14 years away from a 7-figure portfolio.
Yeah. Going back to tell yourself, your past self or your future self that many years ago.
And like you mentioned, you pointed out, I lost a big portion of that portfolio, and you're like, that's a lot of money. Today, that's not a lot of money, right?
Yeah.
It really doesn't matter. And it's, $40,000 or something. And it's still a lot of money. Don't get me wrong.
Yeah.
But that's where I think sometimes, guys, and this is some advice for you, is think big numbers. You will be surprised at what compound. That's the other kind of mistake that I see people make, is what compounds is the return, right? It's not the dividend yield. It's not the dividend growth or whatever. What actually compounds is what the return is. Whether that comes from dividend yield, price appreciation, Santa Claus, whatever. That's what compounds. And that's what we're all, if only it was super easy to be Warren Buffett and get a 21% annual return for 40 years. Right.
Yeah. There's a reason he's
That's what
regarded
we're all
like he is.
striving.
Yeah.
Yeah.
Okay. So this is interesting. I wasn't able to ask this question in previous interviews because I just thought of it. Has dividend investing or investing in general given you any bad habits in life or any good habits in life?
Wow. I don't think so in bad habits. In good habits in life, yes, right? And so again, like I said, I like index funds, I like automatic investments. You go, dude, what do you do with your time as an investor? A lot of it is, making sure I check the box on, different retirement accounts, using them properly, squeezing what I can out of that budget, right? The flip side of that is when I'm looking at spending money, I know what that money costs, right? Mm-hmm. If I go out there and, I know those folks that are anti-loans. I refinanced my house before all this stuff happened at a 2.25% mortgage. I love my mortgage, right? That's the greatest hedge against inflation. I've owned gold since 2013. Another plenty of lesson learned in there. That's not an inflation hedge. A mortgage, that's an inflation hedge, mm-hmm. right? That's $1,800 that doesn't change for 30 years.
Yep. I refinanced at 2.75%, and everybody's like, pay it off early. I'm like, why would I?
Absolutely not. Yeah. Somebody bought that mortgage. Somebody in Dallas, they bought that mortgage a year ago, right? I'm like, you bought a 2.25% mortgage in the fastest Fed rate hiking cycle in the history of rate hiking cycles? Doesn't make any sense, right? And so I've always been, I've never been afraid of loans. Loans for me have always been ways to invest more every month.
Yeah.
Right? Is, hey, I can, and I try to minimize the interest. I try to minimize the payment, right? Make all the math work out, but I'm going to use that so I don't take that money out. Oh. And so that's kind of been the big lesson learned is pick something and I know exactly what the cost of it is, right? Mm-hmm. Whether it's the cost and hours worked, what I can make with that money. And again, make your choice, right? My choice is necessarily the right choice for everybody else. It's your money. Mm-hmm. If you're financially responsible and you want to go out and buy, $600 a pair of cowboy boots, not that I've ever done that, 4 times, whatever. I live in Texas, man.
Yeah, you gotta have at least 4 pairs.
Spend it, yeah. Right? Because you know what the cost of it is. I will say, like I said, no bad habits. However, in all honesty, I still have challenges in the market, right? The time piece of it, even though I know that you got to you got to think long term, and I'm really good at thinking long term. I'm really bad at being patient for the long term result.
I feel that.
Struggle with it.
Yeah.
Even today, even having years of data. It's like I'll put in, tons of buys and the market's moved and they trigger and all this stuff. And then, a month goes by and I'm like, why haven't I made 1%. It's like, why haven't I doubled my money?
You didn't invest in GameStop. That's why.
Yeah. Right. So I still struggle with it.
Yeah.
It's tough. You can be really good at it and know all the right answers. And it's still tough. It's your money, right? You know how long it took for you to work to make that money. So.
Okay, so this is unscripted question, but one I wanted to add to the list.
Dude, why are you using me as the guinea pig for all this?
Because it's a good conversation. Yeah, you're.
No, I'm happy to answer.
I've heard that you're a genius, so I want to ask you all the things.
No.
Yeah. so
I am proof that average kids can do a lot.
Yeah. So. Okay. So I don't have it written down, so I'm just gonna have to formulate this question. How do you not get to the point where you want time to go faster and actually enjoy yourself because of those returns? You know that in 3 years you're gonna have this. So how do you like step back and like actually enjoy the moment in investing?
Depends on what markets you're in, right? If you're in 2021's market or 2020, it's easy because every time you open up your account, you made money, right? It's a lot harder in down markets. And, you know, and there's times, honestly, even last year that I'm just like, dude, I need to take a break from it, right? I need to just close the computer and go do something else. And because, you know, I thought I had a lot more time with to devote to that. And it's like, you know, dude, you're on the computer half the day watching CNBC, researching, reading, and it's like you're maybe killing your brain, right?
Or just buy an index fund.
Go take a walk. Well, not so much that. Again, I've seen my goals today are to do a little better than that, right? And that's where I think a lot of investors that are interested in it. You're on the Facebook page, you're watching YouTube, right? You're reading the books, right? You're reading Benjamin Graham, The Intelligent Investor. You're studying Warren Buffett. Some of the times the challenges for them is you're jumping in and out of positions, right? You get ideas come faster than money. And it happens to me too, right? I hear about a new thing and I'm like, dude, I'm going to go get that. I'm going to go buy that. You know, I opened a position in XLE this year. And it's like, why am I starting, you know, how have you lived 24 or 27 years without a position in XLE? And all of a sudden this is the year that you're like, XLE, buddy, I need some exposure to that.
Yeah.
And so the ideas come faster than the money does. Sometimes you have to just close it, back away from it, right? Go let it sit. And so to answer your question of all that for an index fund is hopefully I'm doing a little bit better than that, right? Is somewhat timing the market. Like I said, last year I put 48% of my income in. Why? So that hopefully over the next 2 or 3 years, I'm not. I'll put in, you know, maybe 15% and enjoy it, right? I'm going to go out and buy stuff. I bought a motorcycle in 3 years, 4 years. Yeah, you know, I'm going to go out and enjoy some of that money.
A fifth pair of cowboy boots, maybe?
I unfortunately have more than 5 pairs. They're work boots, right? I fly jets. We live in Texas. So yeah. And on a side company, there are tax deductions if you do it for contract work. Yeah, that's where I think some of the challenge for the folks that are interested in or on Facebook every day is it's hard for you to let those positions sit, right? I think about there's people out there because I used to be one and I've met them and talked to other people. They're not that uncommon. People that have no interest in investing, they just know they're supposed to. They want to retire, right? They're interested in gardening or lawns or fishing or hunting or whatever. And they invest 15% of their salary or 20% of their salary into their 401k, right? Or maybe a little brokerage on top of that. And they look at it once a year to make sure that the money's still going in there.
Yeah.
Those people do really good.
Yeah. As long as you don't have like a Bernie Madoff situation.
Yeah. Right. The average investor does poorly. They sell when the market's down. They buy into a rising market. They jump in and out of positions, right? And that's where, as a fund guy, as an index guy, it's easy because, you know, when you asked about buying and selling, I've sold out of stuff. Most of the time I've regretted it. Most of the time. And that's been a lesson learned is don't sell out of stuff because you never know when it's going to come back. You bought it for a reason. There's, SDiv. Yeah, no, you should sold that. I sold it. No regrets. But like gold, I bought gold in 2013 after it had fallen. And I was like, dude, I'm getting into gold at the right time. Well, then fast forward to 2015, it's down even more. I sold half of it at a loss to pay some taxes. And then boom, it rockets up to 2,000 a share a couple of years ago. $2,000 an ounce. And it's like, okay, there's a lesson learned there.
Yeah.
You look at rising inflation, you thought, man, gold's going to be awesome. It wasn't awesome. Now, all of a sudden, when the inflation's cooling off, gold's coming back again. Right?
You should write a book called Lessons Learned and just have each chapter is just like a different asset class or something, like gold. Dude, or your index funds or your individual stocks.
I like sharing those with other investors because it's hard to swallow that pill of I made a mistake.
Yeah,
and
true.
One of the benefits from the pilot world, going through Air Force pilot training, if you're a thick-skinned individual, you're not going to make it. Every day you're going to come back from that flight and they may tell you one thing you did right, but you're going to spend the next hour to 2 hours in detail going through everything that you did wrong. And you're going to do that 5 or 6 days a week. And so it kind of builds up that thick-skinned mentality. And so it's helpful in life. It's helpful investing because, you can easily go, dude, I made a mistake there. I screwed that up. And you can talk about it with people, right? And not feel bad. And they go, even if somebody's like, dude, you didn't know any better? Well, I do now because I learned the lesson.
Yep. Good,
right?
Good point.
And there's back to the investing psychology, right? People get emotionally invested into positions, whether it's an individual stock or a fund or whatever, and they're not thinking about it objectively.
And they buy and sell their emotions, which is even worse. As the market goes up, right? They're selling them, and as they're going down, they're buying it. Or actually, I guess the inverse of that. Now
that I've been out of the government and military, and I'm in the private side, almost a decade now. It's a different world, and people go, "Wow, your company doesn't care about you." Well, it's not exactly true. It's business, right? They're not emotionally invested in you, but if you're the best choice, heck yeah, they like you.
Yeah.
Right. If you're a good worker, absolutely. If you drop dead tomorrow, yeah, they're going to list your, position by the end of the week, but people get too emotional about it. Right. If you're a good worker, they love you. If you're not a good worker, they could care less if you drop dead.
Yeah.
Investing's kind of the same thing. I love the stuff that's doing well, right? There's stuff that isn't, and you kind of have to decide, do I hold on to it for tomorrow or do I, cut and run? I still don't have a good answer to that. My best answer is the more vanilla it is, the more comfortable I am holding it.
Yeah. I like
and it's okay to be wrong on stuff.
Yeah.
Right.
Yeah. Well, I mean, and that's the thing too, is if you pick 10 stocks, you don't necessarily need 10 winners. You could have one winner and everything else is mediocre and then like a bunch of losers. That one winner can carry the whole portfolio.
And that's where, right, the stock portfolios, that's true, right? Is the winners are going to win big. And the losers you may have, more losers than winners, but a couple of winners can carry you a long way. I've seen portfolios where one or two names or one name, Apple, right, carried an entire investor's experience, a couple of them, right? Because Apple was up a lot. You go back to 2000, pre-2008, when the iPod, when the iPhone came out, when it was, it was getting common and getting cool, the folks that bought Apple, Apple was huge, right? Where you're sitting today in NVIDIA, you may be that, right?
Yeah.
NVIDIA could be huge.
Yeah. Yeah. Who knows? We'll have to see. Okay. Next question. And so I need you to pick an individual stock, no ETFs. If you could pick you could only pick one stock, you can pick a regular stock, whether they pay dividends or not. Dividends, again, preferred.
NVIDIA?
Yeah, well, you could. Yeah. One dividend stock for the rest of your life. What would it be and why?
I'm going to break your rule, man. I don't have to, and I wouldn't. And I see, and here's why, and you can delete this out if you want. A lot of, and I'm sure you see it too, is you see that question, right? Hey, if you could have, on Facebook groups, if you could pick one stock for the rest of your life, hey, should I go all in? I can't think of how many times I've seen that question. Hey, should I go all in on? I'm like, dude, you shouldn't go all in on anything.
Yeah.
Right. All in is what you do in Texas Hold'em. I don't know about you, but I suck at Texas Hold'em. Terrible at it. But there's, at first I thought, okay, these are fringe questions. They're more common, right? Of, even with dividend funds, right? People are like, oh, I've got 3 funds. Well, you have 3 large cap US dividend funds. You have one tiny segment of the market.
Yep.
And so, even to play along, I'm not answering the question because I think it's a bad thing.
Yeah.
It's a bad mentality, right? Whether you're a stock picker, even as a dividend, if you're a stock picking, dividend only value investor, Warren Buffett, I got his book, I go to Omaha, all of that stuff. Even that guy, you're going to have diversity out there, right? You need to think about portfolio construction, right? Even if you're an index fund guy, even if you don't invest in the rest of the world or you're not in any fixed income, right? You still have to think about portfolio construction. So yeah, man, I'm sorry.
You're okay. Yeah, I always like to ask because the answers that I get, whether it's a non-answer or an answer, is always interesting to me. So
I tell you, years ago, I kind of did a deep dive into common investor mistakes, and it was hugely benefit. And my goal was, and I had been investing for a while. My goal was to go, hey, dude, I hope you're not doing any of these. And I think for the most, I probably wasn't. Those are things that we can control. If you go, hey, Justin, what's the market going to return over the next 5 or 10? Whether it returns 8 or 12%, I'm going to invest the same, right? The things I can control, right, are mistakes that I make, how much money I invest, right? How much I move stuff around. I hate rebalancing. I don't rebalance. I don't want to ever trim a winning position and put that money into a losing position.
Yeah.
Right? I'd rather buy my way into the balance, right? I'm going to let the winner run and I'm going to buy more of the one that's lagging because it's probably beat up, right? Small caps right now, small cap value over the banking crisis, they're all beat up, right? I'm not going to sell triple Q, right? Because I think it's got a lot more to run, right? I'm not selling the XLK right now because people are like, oh, tech's overvalued. Well, it might be unless it doubles in value.
Yeah. It is till it isn't.
I'm going to put new money towards small cap value, right? And buy that portfolio and I have a rough outline, but I don't worry about it, right? I kind of let the market do whatever it does because the market doesn't conform to our calendar, right? It's, you go, I rebalance 4 times a year. Bro, really? Does the market really give a shit?
Yeah, yeah, exactly.
Does it line up with those? Probably not, right? I'm always happy when, back to dividends, I'm always happy when the market dips on March, June, September, the big dividend months, right? That's awesome because on the quarterly dividend payers, sweet that the market dips, right? So there you go.
Yeah, I like it. Okay, so last question for you.
Didn't you say last question 3 questions ago?
No, I didn't. Yeah. I don't think so.
Dude, I'll tell you what. You have really good questions. Solid questions.
Well, there we go. I'm glad to hear that. This is only my 4th interview, so I'm hopefully it gets a lot better as I go because I'm still learning.
It's really solid. I don't know how bad the first one was. But
well, let tell Chad about it if it stinks. We'll blame it on Chad. Okay, so last question. Do you have any advice for someone just getting started in dividend investing or in investing in general? And if your advice is to just get started, what other advice do you have?
That definitely is it, right? 80% of the time the cheapest price was yesterday. I mean, the market goes up 10% a year, right? So when you average that out, generally yesterday was the cheapest, right? From my perspective, conventional wisdom works, right? I think too often, people think, oh, dollar cost averaging, right? That's what new investors do, or index funds. Those are for new investors. Those things work, right? The conventional wisdom, it works. I'm proof of that. You want a 7-figure portfolio? Automatic investing for 2.5 decades into some vanilla index funds. Boom, you're gonna have a 7-figure portfolio. It's the conventional wisdom for a reason, right? And it works for everybody. Now that's not to say that there's not. I don't. Obviously I'm pro index funds, but dude, go buy a couple of stocks, right? You may have a knack for it. Just because the stats say that everybody else, doesn't do great with it, you may have a knack for it. And the best way to learn is go out and put some money towards it, right? And I've been asked that question before, and I really do try to put a lot of thought into it. And I go, okay. Or the other question, hey, what would you do if you started over again? Well, I'd buy index funds, obviously. But I go, what would you do if you were a new investor? One of the ways, and I don't have a great answer for that, is, dude, buy whatever you want for 3 straight years and then figure it out, right? Learn, read books over that time, but buy it, buy a share of it, buy 2 shares of it, but buy whatever you want for 3 straight years. Learn as much as you can and then sort it out, because we all bought stuff that we shouldn't have, right? Me telling you to don't buy that, you're probably still going to do it, right? Yeah. Where you go, that's some stranger on the internet. Or maybe I'm wrong, right? That's the other thing too. I could be like, dude, I'll tell you what, I think this is going to outperform that fund. And it may not, right? And I know that. I know that for a fact, right? I can tell you that in 27 years of investing, everybody's bad at predicting the market. That's my investment thesis, right? So buy whatever you want, try some stuff out there, but then kind of go back and make that next leap, right? Figure out what works. Try to avoid the yield chase, the performance chase, jumping in and out of positions. That's the one for the new investor that I think is the most obvious to not new investors, but maybe not obvious to new investors. Is somebody goes, yeah, hey man, I've been investing for 4 or 5 years, and hey, look at my portfolio and tell me what you think, right? So they hand you their phone and you look at it and you go, you have, the returns don't make sense, right? The returns don't make sense for the time frame. And so then you ask them the question, okay, how long have you had these positions? And they don't have a single position that they've held more than 2 years. And you go, okay, well, what did you do? Well, I bought this. I bought AT&T because I'm on the dividend fund, and everybody, 2-3 years ago, everybody was loving AT&T, right? I bought 3M. I bought Disney. And then, they tanked. And so I bought this other thing, right? And they're learning, they're doing the right things, but they're not keeping that long-term perspective in there. And the best thing, back to the whole time in the market, right? Half of time in the market is returns, half of it is experience and learning about it. When you're a new investor, when you're a young investor, when you were, all of it, you're not risking a lot of money, right? It seems like a lot of money, and it is enough money to keep you serious, right? But you're going to make those mistakes then, right? When you're having a 4 and a 5-figure portfolio, so that when you're at a 6 and a 7-figure portfolio, hopefully you have eliminated them, right? So for a new investor, absolutely, man, go out, buy stuff, right? Start that learning process and figure out what works for you, right? Hey, I love QQQ, but not everybody's going to watch a 34% price drop in their money and go, I'm going to own that, right? There's folks that are going to have a knack for stock picking. They're going to walk through the grocery store and they're going to be like, I see a lot of ConAgra or, I see a lot of Hershey's or, whatever, right? They're going to have a knack for stock picking. Would I recommend that person buy index funds? No, right? If you happen to have that knack, yeah, go ahead, go pick stocks. A whole bunch of folks out there, right? A decent portion aren't going to do well. Do I recommend index funds to them? Absolutely, right? That's a guaranteed return. You buy the S&P 500, you're guaranteed a market return, right?
Yeah.
Not a lot of guarantees in investing.
Yeah. Death and taxes is the only guarantees I know of, and 8 to 12% in the S&P 500. You got to add that one in there.
Right, and whether it's 8 or 12, who cares?
Yeah.
Right. One of my most hated things with investing is, and I hear it on, I don't know about you, I listen to CNBC and Bloomberg, right? In the satellite in the car and then also on television. And I hear ads for the lost decade, or you read it in the news, the lost decade. And it's a horrible idea, right? There's very few times you don't have to pick, wow, the market was right here, and this one portion of the market took 10 years to get back to that, right? And it's like, what if you kept buying every month during that? Well, hell, you were up 37%, right? Yeah, it's an interesting world. Investing is a fun journey.
Yeah, I agree with all that stuff. Like, there's so many lessons to be learned. Picking stocks for 3 years just to learn your lessons. Like I said, I always say you have to learn from mistakes, but nobody said they have to be your mistakes. But
exactly.
The mistakes you learn from the most are the ones that you make yourself.
And that's where I think it benefited me, and I think it'll benefit every single investor out there is go look at what are common investor mistakes, right? Because if you can read about it and go, oh yeah, shit, that's a horrible idea, and not make that mistake, if you can learn it from somebody else, or if you read it on a Facebook comment, right? Whether it's from me or you, and you go, hey, I made this mistake, and somebody else doesn't, that's even better, right? Yes, you need to learn from your own, but the better thing than that is learn from somebody else.
Yeah, let somebody else pay for that mistake. You don't have to. Yeah. I mean, that's really one of the big things, one of the big goals of this series that I'm doing is there's going to be a bunch of good things that people I interview have done, a bunch of bad things that people I interview have done. And if there's...
And I think hopefully, right, is they'll probably get more out of the lessons learned, right? The mistakes people made, because again, it's tough, right? Nobody wants to jump on a Facebook group and go, hey guys, let me tell you about that time I lost $20,000 in the market, right? It's easy to go, hey, I'm up 60% in the NASDAQ, and it's the best thing out there. It's, it's common fun, right? There's 90% of my comments. But when people actually say, hey, look, here's mistakes I made, here's lessons I learned, one, hopefully they'll resonate a little bit, but they'll go, hey, look, I'm not the only one making mistakes.
Yeah.
And sometimes it's easy, for experienced investors to forget that we were inexperienced at some point and we made a bunch of mistakes. And so somebody asks a question and you kind of come in there a little type A personality and you're like, that's a terrible idea. And you forget that you had some terrible ideas when you were new too.
Yeah, that's true.
Thank you all so much for watching today's interview. If you would like to help me grow the YouTube channel, please consider leaving a like on the video and then share the video with others that might enjoy it, as that helps spread my content. And if you enjoyed this type of content and all things dividends, make sure you guys are subscribed with the bell rung so you don't miss any of my future uploads. Lastly, if you would like a chance to be on an episode of Dividend Discussion, send me an email over at dividendobsession@gmail.com and we'll be in touch. But until next time,